Okay, good morning, everyone. It's a pleasure to be here. I think Paul gave a very good overview of the role of the Chinese economy in a global context. As you know, China is now the biggest economy in PPP terms and is also contributing 1/3 to the global growth. So I think I don't need to convince you how important this topic is, that is, what is the growth potential in China? And I think, as Matt highlighted, recently there's really growing concerns about the growth potential in China. And I think to summarize, there are broadly two types of concerns. One type is more about a structural stagnation. And the second type of concern is, as Paul also alluded to, a more disruptive adjustment because of the debt overhang. So let me talk about the first type of concern. Why people are now start to concern about China's potential growth? This is related to the concept of middle income trap. The concept says that when countries reach middle income level, there's a higher probability of sustained slowdown so that your further convergence to the high income process will just stall. And you can see that from the left chart. You see, China has really reached the income level where a lot of rapidly growing countries in the past then started to stagnate. There are only a few economies that continued this high growth, such as Taiwan and Korea, and then they converged very fast to high income. So this is part of the structural concern. And the second type of concern is related to this debt overhang. So in the right-hand side chart, you can see that historically, for countries that has experienced a credit boom in a short period, most of these countries didn't end well. So it's mostly followed by a very disruptive adjustment of the GDP growth. Now, so it kind of justifies people's concern, is this something that is also going to happen? So this is a broad background that I would say why now this topic has become so heatedly debated. So if you look at the literature, there are broadly three streams of views about the growth potential in China. The more bullish views say that China can still grow at 7 to 8% in the next decades. This is mostly, famously proposed by Justin Lin, the former VP of the World Bank. And then there are also more bearish views saying that, China cannot escape the mean reversion, so growth will slow to 3 to 4% very soon. Especially, this is a view shared by Professor Barrow. And then there is also another stream of view, which is, I would say, the Goldilocks view, say that, growth is not going to be too high, but it's also not going to slow too quickly. So we're going to see something between 5 to 7%. And if we dig a bit deeper behind these views, it really depends on the methodology that you're using. If we look at the people who are more bullish, who are very bullish about China, normally they reference the experience of the Asian tigers. Indeed, for Korea, Taiwan, or even Japan, when they're at China's income level, they were still able to grow at 7 to 8% for a sustained period. And then if you look at more bearish views, the mean reversion concept, their benchmark is completely different. So for example, in Barrow's paper, he's looking at average countries' growth performance. So you can see that the two more extreme kind of views, they're all based on comparative studies, and because the benchmark that they have chosen are different, so it gives you completely different prediction. And that's why to analyze China's potential growth, it's very important to look into more China-specific factors. So that goes to the third stream, where typically, as Paul also mentioned, people would refer to the production function to look at the growth potential for China. So in one of our recent papers, this is to formalize this idea why it's so important to choose a benchmark. So in this chart, you see three lines. The green line is a model prediction. So this is what we did based on the conditional convergence theory and the results from a panel regression. So the green line shows you the model prediction if you choose your sample, just based on the Asian tigers. And the red line is the model prediction based on a global panel. And then the blue line is the actual growth of China. So you can see that historically, the growth performance in China is more in line with the model prediction from the Asian tigers. Now the question is, going forward, whether the blue line will follow the green line or the red line. So this is where international experience stopped to be useful. So it gives you a range, but it doesn't pin down exactly where it's going. So that's why this is where we have to look at China's specific factors. And if we go back to the production function, this is still, in our mind, to analyze medium-term growth, this is still probably one of the best useful tools. And as Paul already mentioned, in a production function, there are really only three things that could contribute to growth. One is physical capital accumulation, second is labor, and then the third is total factor productivity. We know that, with the aging and shrinking labor force, labor is not going to be a significant driver of growth in the future. And then on the physical capital side, in the broad context of rebalancing from investment to consumption, we also know that physical capital accumulation is going to slow. So this, again, is not going to be a significant driver. So really, it's all about productivity growth. And China do face a structural downward pressure on productivity growth. And why is that? This is very much related to the structural transformation in China. So if you look at the right chart, the share of the industrial employment in China has actually already peaked 2 years ago. So what we're seeing now is some labor reallocation from the industrial sector to the service sector. And then if you look at the left chart, productivity growth in the service sector is much lower than in the industrial sector, which means in the process of reallocating labor from a high productivity to low productivity sector, structurally, your aggregate productivity growth is going to slow. And that's what really is driving the overall growth slowdown. So how did you buck this trend? This is where reforms come in. We all know that the government has announced a lot of reforms. So at the fund, we typically would have different growth scenarios based on the degree of implementation of these reforms. So as you see in the black line on the left chart, this is the most optimistic scenario. If the government implements everything that they have announced, then you will see up to 1 percentage point pickup of the TFP growth, which will really drive up growth to about 6.5, even in 2020. But then in the no reform scenario, the blue line, that's where you don't have a pickup of TFP because of the structural reform, you just have this structural downward trend. And there you will see a sustained growth slowdown. And of course, among the reform, there are a serious reform that the government has announced. But let me just highlight the key reform among all this is the SOE reform for TFP growth. To tell you why, on the right-hand side, you can see that the return on asset for SOE, that's the blue line. And the return on asset for the private firms is the red line. You can see a widening gap of the return of this two type of firms after the global financial crisis. So if one can, even SOE today does not account a significant share of employment in the Chinese economy, but they do account for a lion's share of the total assets. So how efficient those assets are used is key to the TFP growth in China. So reducing this gap by SOE reform would be key to the TFP growth in China. But of course, reform is difficult. And so there's always, when there's difficulty to do reforms, and if the government already has a target to reach, then there's always an incentive to pump in more credit. So at the fund, very often, not only we look at the headline growth number, but also how much credit that was needed to generate that growth. So we can see that in a proactive scenario, if you do reform, you can achieve a higher growth rate, but with a much lower debt in the medium term. While in a no reform scenario, despite you can achieve slightly higher growth in the near term, but the amount of debt that you need is significantly higher in the medium term. And not only that, the chance of disruptive adjustments would also increase substantially over time. So the dotted red line shows you what the growth would be if there is a disruptive adjustment. So I think to summarize, we still see a lot of growth potential in China because of its income level, but really it faces a lot of headwinds because of demographic changes and also the structural shift from industrial to services. But we do think that if the government implements all the reform well, then it can still achieve a relatively high growth rate, about 6%. And more importantly, they need to reduce the credit intensity of growth. So the debt profile is equally important for China, compared to growth per se. Thank you.
Thanks very much. I'd love to have a vote at the end, a secret ballot on what the odds of serious reform is, or what confidence people have that can really work.